The stock market attracts people for the wrong reason first. They don't come because they love businesses. They don't come because they enjoy probability. They come because they see money moving. Money looks fast. Money looks easy. Money looks emotional. And that illusion pulls people in before they ever understand what they are stepping into. The market doesn't care why you're here. It only reacts to how you behave once you are. That's why two people with the same information can end up in completely opposite places. One survives. One disappears. Most people believe failure in the market comes from bad timing or bad stocks. It doesn't. It comes from misalignment. Misalignment between personality and strategy. Misalignment between expectations and reality. Misalignment between patience and pressure. Investor and trader are not labels. They are mental contracts. Once you violate the contract, the market starts charging penalties. An investor enters the market accepting uncertainty up front. They accept that they cannot control short-term outcomes. They accept that prices can fall for reasons that make no sense. They accept that being early feels painful. What they don't accept is permanent damage. They are willing to look wrong temporarily to avoid being wrong permanently. This mindset changes how fear operates. Fear doesn't disappear. It gets delayed. Instead of reacting immediately, the investor filters fear through time. Time becomes a buffer. Investors understand something subtle but critical. The market transfers wealth from the impatient to the patient, not from the ignorant to the intelligent, not from the poor to the rich, from those who cannot sit still to those who can. Patience is not passive. It is controlled restraint. It is the discipline to not act when action feels emotionally justified. This restraint is rare. Human biology is not designed for delayed reward. Your brain wants feedback. It wants confirmation. It wants progress you can feel. Investing offers none of that in the short term. That's why investors are constantly tempted to become traders. Not because trading is better, but because it feels alive. Trading feels like control. You click, you enter, you exit, you feel involved. That sense of involvement is dangerous. Because the market does not reward activity, it rewards accuracy under rules. Traders who confuse activity with productivity burn out quickly. They trade more to feel better. They trade more to recover losses. They trade more to feel in control. And control slips further away each time. Professional traders are not busy. They are selective. They spend more time waiting than acting. They understand that no trade is better than a bad trade. They are not addicted to the market. They are disciplined around it. That discipline looks boring from the outside. But boring is where consistency lives. Trading punishes ego faster than investing. The feedback loop is immediate. If you are careless, the market responds instantly. If you are emotional, the market responds brutally. There is no grace period. You don't get years to be wrong, you get minutes. That's why trading exposes personality flaws faster than any profession. People often say trading is about intelligence. It isn't. It's about obedience to rules you created when you were calm. In the moment of execution, intelligence is irrelevant. Emotion takes over. Only systems survive emotion. Investors build systems too, but slower ones. Allocation rules, rebalancing schedules, valuation thresholds. These systems protect investors from themselves. Without them, long-term investing turns into reactive speculation. One of the most dangerous moments for an investor is success. When things go up easily, discipline weakens. They start believing it was skill, not environment. They lower standards, they stretch valuations. Then the cycle turns. Markets don't reward confidence, they test it. The same is true for traders. A winning streak is more dangerous than a losing one. Losses create caution. Wins create arrogance. Arrogance loosens rules. And once rules loosen, risk leaks in silently. By the time the damage is visible, it's already done. Both investors and traders must fight the same enemy. The enemy is not volatility. The enemy is self-deception. The belief that this time is different. I'll exit later. I don't need a stop. I'll add more. It will come back. The market has heard every excuse before. It does not negotiate. Another uncomfortable truth. The market does not owe you opportunity. Missed moves are part of participation. Trying to catch everything guarantees catching nothing well. Professionals miss trades regularly. They miss rallies. They miss bottoms. They don't chase. Chasing is emotional recovery, not strategy. Investors miss rallies too. They watch stocks double after they sold. They watch sectors run without them. They feel regret. But regret does not rewrite process. They understand that process beats outcomes over time. That understanding is rare. Most people want validation, not results. They want to feel right now. The market rewards those who are willing to feel uncomfortable now to be stable later. This applies to both investing and trading. Comfort is expensive. Another reason people fail is comparison. They compare returns without comparing risk. They compare timelines without comparing behavior. They see a trader make fast money and feel slow. They see an investor grow steadily and feel impatient. Comparison creates strategy drift. Drift destroys edge. Edge is fragile. It only exists when behavior stays consistent. The moment you change rules mid-game, edge disappears. That's why switching styles repeatedly is fatal. Not because any style is bad, but because mastery requires repetition. Mastery in the market is not dramatic. It is quiet. It looks like passing on trades, holding through boredom, accepting small losses, ignoring noise, repeating the same actions again and again. This doesn't sell well on social media, but it compounds in reality. The market eventually exposes everyone. It exposes impatience. It exposes greed. It exposes fear. It exposes ego. Not immediately, gradually. And by the time people realize what went wrong, they usually blame something external. The market, the system, the timing, rarely themselves. The people who last do something different. They treat the market as a mirror, not a casino. Losses become information. Mistakes become feedback. They adapt behavior, not excuses. In the end, the difference between an investor and a trader is not speed. It's where responsibility is placed. Investors place responsibility on business quality and time. Traders place responsibility on execution and risk. Both accept responsibility. Most people don't. And the market does not reward avoidance of responsibility. It charges interest on it. The market is not designed to be fair. It is designed to be efficient at transferring money from those who don't understand themselves to those who do. That is not cruelty. That is structure. And once you understand that, the question is no longer how to make money fast. The real question becomes, which version of discipline are you actually capable of sustaining when nobody is watching? Because that answer, not intelligence, not capital, not luck, decides everything. Thank you for watching. If you found this video helpful, make sure to like and share it. And don't forget to subscribe to Money Mind Professor to become a part of our financial learning journey. Here we talk about saving smarter, investing wisely, improving your business, and developing a strong money mindset. Stay focused, stay consistent, and stay financially smart.